Welcome everyone to the Kendall Report, where I share my 44 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. I haven't been online for a number of days, so I'm going to cover the rally that we just had and what it looks like going forward. Let's get into tonight's video. Welcome everyone to the Kendall Report. Looking for some folks to start to join. It's kind of an impromptu live stream that I'm doing tonight, so hopefully you'll get a chance to watch some of the replays, those of you that didn't catch the live. So welcome everyone. And yeah, so apologize for last night. And I've been contemplating all day actually whether I was going to share this, but I guess it's appropriate with the DNC going on right now. So those of you might know that I live in Arizona. We happen to have a border with Mexico you may be aware of. And I sit here and it almost feels like you're being invaded every day. And the reason why I tell you this, last night at midnight, I work late. I write the Substack sometimes between 10 and 2 in the morning every night. And I decided to share this because last night, my wife goes to take our dog out for a potty. We back up to a big open space and kind of the last house on the street kind of thing. And she walks out and there's a Hispanic guy standing 20 feet from her in our backyard. And you can imagine she screams. I'm in the back room working, door closed. I don't know this has happened, but I always wonder, like, how many lives is this craziness going on the border going to affect? And I always thought, well, it would be someone else. Well, it actually, this guy definitely was a immigrant, illegal, and I'll just say all the words out loud. And it's just crazy what happened last night. So I literally was in the middle of writing the Substack. So I apologize for those that get the Substack letter. That I only covered the S&P. I couldn't get my head together after what was going on. As you would suspect, my wife was completely freaked out, to say the least. So anyway, I share that with you because it's just, I think the message, and as we come into the elections, has to be really clear on what you're doing. And I know this is not a political station. I'm not trying to make it that, but it was so impactful what happened. Everything feels differently where I'm sitting right now. This always felt like a safe place. Doesn't feel like a safe place. America doesn't feel like a safe place. So I said it, and I just really wanted to let everybody know, pay attention to everything around you, because this was so unexpected. Anyway, so let's get into tonight. So let's talk about the video. Thanks for listening to me. I needed to air that out, and for the best that I could. So let's talk. Let's get into the markets here. I've been talking a couple things on Substack, and I've been talking about there's a pattern. I always tell everybody if I were in Vegas, I would be banned from Vegas because I would be a card counter. And I always count bars, and there's a bunch of patterns. And I'm going to do a video on all these different configurations that I have noticed and recognized over the years and years, decades of actually doing this for a living. And one of the patterns that I was talking about was this 858, or could be end up being 835s. There's a whole bunch of potentials here, but I was talking about the 5620 that somebody that mentioned. That was the target zone. We definitely got there, and the market's kind of reversed, got a little bit above it, but we're definitely seeing a little bit of backfilling here. So let's talk about a couple other issues here, because I think there's some things that are probably that need to be discussed. one of the things that a lot of folks tend to be talking about is, how the Fed's going to lower rates. And there's something going on here that I've been trying to unpack. I think I've told you folks, those of you the long-term watchers know that I do something called reverse fundamentals. So if something's going to happen, I see technical or from quantitative or from our database, what I will do is try to go back and say, okay, what would make that happen that's currently available in the markets right now? And the result of that is that what I'm seeing here is folks talking about lower interest rates, but the environment is not indicating that there's any need for the Fed to do anything. And I believe this, I'll continue, we're going to come into September. I'm kind of bouncing around between a 50-50 that maybe they lower the rate by 0.25% in September. I know a lot of folks are looking to Jackson Hole this week. There's going to be some announcement. There's not going to be any announcement there, I don't believe. I think all we'll hear is the same rhetoric that we've been hearing, data dependent, and yeah, things look better, but there's always going to be a but in there. So I think this is what we're really looking at from the Fed's viewpoint. I don't think we'll see anything from the Fed that's going to be reviewing ahead of the meeting. I think Powell will be very careful about what he says there and whether there's anything that is likely to come out of that. I think it's minimal, although when he talks, it tends to be bullish. And I'll show you here in a minute, as those of you that have the indicators, and if you don't, go to kendallreport.com/indicators. You can find out more there, and there's a super discount rate. Go there. If you ever have any issues with the order button, just go to incognito mode on your browser, and that'll fix it. But the issue that I'm looking at here is that the Fed is not driven to do anything right now, and I think they're going to stick to the patterns. I'm going to go to November, December. I'm also working on a project that I'm going to talk about the Fed's new strategy. I've been talking about it for a couple years now, and one of the things that I've been discussing is that I believe the Fed is looking at a bigger, longer-term picture. And I'll go through the details because I think it's worthy of a complete video on the new strategy. And Powell announced it about probably last year. I believe it was mid to early last year what the new strategy was, and I seem to be the only one that caught it. Many of you that are probably watching this video think that the Fed is going to micromanage, and if the market goes down, I even fell a little bit into that when we were seeing the carry trade unwind. I fell into a little bit, maybe they could do an emergency, but then I caught myself, and I think the next night in Substack, I discussed that, I realized that they don't need to do this. And in fact, they're not going to manage the markets like that anymore. So I will save a lot of these details for this video I'm working on, but just know that it's going to be very solid and as far as things go from that standpoint. And I just warn you, if you hear a dog barking, I am working from home. So I'm not at my studio where I usually work from. That's why I'm on green screen and doing the environment I'm in right now. So I apologize up front in case I get anything. He hears me talking and he'll start barking. But anyway, so one of the things that just kind of moving forward, and we'll get into the crux of what I want to cover tonight. I do have the results of the database. I'll show you what that looks like. I'll be writing the Substack full version tonight. Hopefully we're not invaded, and that will happen. So just know that the plan is that I'll continue to keep things going. And if you're not getting the Substack, you should. I did raise prices a little bit, but if you do a full year up front, you can get it for like 12, I think it's 12 and a quarter, $12 a month. So I really work hard on that. I put a lot of effort into it. And that's where you're going to get a consistent delivery of my thoughts and things like that. So we'll go from there. And I'll address some of these questions that are coming up here. Yeah, just a comment here. The open border policy is completely crazy, and especially if you're in Texas or Arizona and California, they seem to just brush it off, but it exists there as well. So I would tell you that this character, I caught him on our front camera, and it looked very Venezuelan to me. So not trying to offend anybody or blame them, but he looked different. He was definitely Latino of some sort. Anyway, onward we go. Yeah, so let's try to do this. So we're pretty efficient. 10 minutes in, let me try to just hit through a bunch of markets. I see people asking about crude, and maybe we'll do this a little more interactive. This is an impromptu. I felt bad about last night not being able to get a full Substack out. I thought I was going to be able to do last hour today. So here we are at 9 o'clock in the evening in Eastern time. So, but let's go ahead and let me get set up here. And we can start. Matter of fact, we're going to start off with the database first. So let's get into taking a look at that. All right, so here's the database. This is the daily. We're up to 64%. That's roughly where we were last night. Very flat. We only had 287 new entries, 155 exits. So basically a rotation. The database usually will peak out between the 62 to 68, maybe as high as 72%. And I will cover Bitcoin here. We're going to run through the whole gamut of the markets here. So not really much to talk about here other than we watch this database on a short-term basis. I've talked about this in the Substack, that we're really looking at this massive volatility in the database swinging. And typically within one intermediate, let me go over to the intermediate viewpoint here, and you'll see it's 67% long. It stayed above 62%. I remember somebody on even YouTube or on the maybe it was YouTube or maybe on Twitter, somebody going back to last January, February, when the database was getting a lot of traction. I remember telling everybody, we're probably going to be, this is suggesting we're going to be higher at least into July and possibly into October. And this looks like this database is actually extending, and it is suggesting that we're going to keep going. And we've been driven by basically these 6 sectors you see up here: conglomerates, consumer non-cyclical, financial, healthcare, services, and utilities. Utilities is one of the newer ones, but all of these others have been on for a while. We don't see any new rotation coming in on intermediate level. So basically it's a 50-50 market. We're 67% on. It's not just stocks. It actually has ETFs, mutual funds, and individual stocks. So we have another database that we're working on that's going to give you just the rotation that's happening on the stocks. But this database is really just coming up with showing us where the concentration is and all that. I think what I'll do while I'm sitting here, I was noticing something here earlier, is that the Mag 7 portfolio, I'll bring up on the screen. Let me get off screen here so you can see this. The Mag 7, right now there's 5 of 7. Microsoft and NVIDIA are neutral right now. We have 5 of the 7, and this portfolio is still up 41.18% this year, and it just continues to grind on. Now, this has been updated as of today, and so we continue to see this, although it pulled back pretty substantially with that pullback that we had, but it's been hanging on to most of these positions. Yeah, so one of the things I want to do, I'm just going to answer Mike's question. Bob, could you talk about how to enter a position, example R1, R2, how to know when to wait for each. I will do this. I won't be able to do that today, but I'm going to do some videos, training, live training, and I'm hoping to get live in the market so I can show you intraday, especially on some of the shorter term charts, and how to do that. That is something that is necessary. I'm not sure I covered that incredibly well, even on some of the training videos and some of those things that are out there. I think there are some gaps in there that need to be filled. So just know I won't be able to do it tonight, but I am planning on doing some things. In fact, there's a number of videos I'm trying to work on. There's just been, last night was so disruptive. We were up all night, didn't go to bed till 6 a.m. So it was hard to sleep after the events of yesterday. But yeah, so let's, so just looking at this, at these portfolios, we're just seeing a continuation here of a lot of patterns. I showed you folks a couple of weeks ago, I did a IWM hack, and I came up with 12 stocks out of IWM. That portfolio is up almost the same as the Mag 7. And this is right now up 41.24%. And I'll show you some of these open positions here. Let me get off screen. Actually, it's fine. You can see them well. But these are the stocks that are currently long, the P&L. Some of them are incredibly crazy numbers. BPMC is up 107%. So some of them have run. And I know you hear all the time that the entire market is being driven by the 7 stocks. And meanwhile, everybody's trading IWM, and it's a dog with fleas at best. It's not, it represents the index, but it's so weighted. If you go to something like, I think it used to be called ETF DB. I'm a subscriber. They call it something else now. But if you go to ETF DB or one of those and look at the constituent list of the IWM, you're going to see it's a ton of junk in there, and it's weighted towards, it's cap weighted. So you get the front end. Now, I went through, and when I hack a ETF, I did a completely different type of hack. And I'm going to show you guys how to do this. And I keep telling you, a lot of folks, I see criticism sometimes around Twitter and other things like, oh, he's just selling his products. These products will help you if you learn how to use them right. The issue is I need to put the time in a little bit more on this product so you guys know how to go forward, because there's going to be a time where this market's going to peak out in the next couple months, and you're going to need this for the sell discipline more than anything else. And I just put it out there. If you do want to check it out, it's an old landing site, but kendallreport.com/wavetech, and that's WAVETECH. So just go there if you want to find out more. But the reason why I show you this is people are, this is up the same as the Mag 7. And some of these trades have been on for a little bit. A number of them came in last November. And I mentioned this before on IWM. Our models actually bought IWM back in, I believe, November or early December. And that's, so we've been long. It's just still an underperformer. And even though it looked like a catch-up trade or overperform trade, Stanley and Tom couldn't bid it up enough, and all their rhetoric that they put out there. And I warned you folks on the Substack that this market, they basically on the IWM and the Russell sucked everybody into that trade, and they slaughtered them. And they just smashed that trade all the way, taking out the June lows. And now we're just in recovery mode, and it's bouncing back with all the indexes, but it's still major lagger. So anyway, I just want to point out some of that stuff. So I'm going to do my best here just to kind of roll through. We're going to do S&P, NASDAQ, all this stuff that I cover on the Substack. And then we'll go into including Bitcoin. And I think we should, if I don't bring up oil, we should look at oil and gold. Gold's had a pretty good run. and just look at. I think we should also look at the dollar as well. I think there's some things going on there that's worth going. And yeah, thanks, Suzanne. I love doing the live streams as well. Kind of a flow of consciousness sometimes, and I end up stubbing my toe once in a while, getting into some crazy rants about stuff. But let's go ahead and let's go over and take a look here. I've got the S&P. This is daily up here. I want you to see now. Those of you that have the indicators, those red dot indicator, that thing has been spot on and projecting this rally. If you look back, it's been continuing to project that we're going to stay over the 10-period moving average, which it did. And if you go back a few days ago, those of you who have it, and I'm going to show you the settings again because people, this is not a special indicator. You already have it if you have the indicators. But I'm going to show you the settings here real quick. And when you bring it up, it's just, you can choose any of the WTAR forecast indicators, and all you have to do is set the period of the SMA to 1. So what it's doing is projecting daily closes, and then nothing else needs to change. I put like 2 weeks of bars ahead time. You can put it out further, but it really doesn't have a lot of relevance. But I like to look at the next 3 to 5 days, see if it's forecasting higher. Also looking and compiling this with the market grid, which gives you a pretty decent range as far as what to expect. And I lay that out in the Substack as well. So you get, like I said, the Substack is important. I believe there's a 7-day trial that you can do. Yeah, so yeah, I will talk about that. Great question. Can you please explain what's behind the significant price rise on low volume? Low volume is what drives the market. It's not high volume. And that is, there's a couple things. I have a pet peeve. Anybody that talks about Edwards and McGee, Head and Shoulders, all the different patterns, triangle all the stuff from Edwards McGee, I threw that out in 1980 and just couldn't get anything to work. But the same thing with the volume, folks. They tell you got to have high volume. Volume does not cause the markets to move at all. Okay, so I'm an ex-floor trader on the floor. I'm going to give you an example. We're going to do a quick lesson here because I think this is something that is very, very misleading and very misdiagnosed as what's going on. So what drives markets is not how many trades there are, but the aggressiveness of the trade. Okay, let me explain. So we're in looking at a level 2. I get 1 million shares to buy. Another person has 1 million to share, and I'll do it in half. So I'm offering to bid. I'm bidding for a half. The other offers come in at 5/8. And back in the old days, we'd yell at each other back and forth. Now it just happens. We just post it in a digital world. But what happens is somebody even has to move down to the bid or up to the offer. And if we just cross trades, and I got 1 million and I show my 1 million, then it's just going to match up. Let's say it doesn't matter. It's going to move even 1/8 or a half. So now let's put an example of what makes the market. So now I have 1 million to buy, but I'm only showing you 100,000. Okay, the offer is 100,000. So if I want to bid the market, this was old, and I think those of you who've been in the live room, I've done this in the futures market as well, where if you have a small offer, you just go and you take the offer and then you bid more at the next price. So example, it's half bid offered at 5/8. So you would just go up, buy the 5/8, and then bid for 200 at 5/8. What's going to happen to the market is someone's going to go from 5/8 up to 3/4. I'm just doing it in eighths, so to make it easy. So now it's 5/8 at 3/4, and there's 200 there. I've got 1 million, remember. I'm going to buy those 3/4. I'm going to bid for 200 at 3/4, and now all of a sudden the offer's 7/8. So I moved. If I'm aggressive, I can move the price up a quarter or a half just by taking out those offers and then rebidding for the market. So the aggressiveness of the buyer or the seller matters more than the volume. So volume's always there, but when you see a low volume rally, that means this rally can go and go and go. There's no excesses in the rally. What you have is an imbalance of aggressive buyers. That's what we've been seeing. So this is perfect. This is such a good question, because what we just watched this happen and we're seeing it happen. So low volume sell-offs, low volume rallies can last forever. We've watched 8 days now, right? There's still a little bit of a bid. We're up 450 overnight right now. But the issue is that it's the aggressiveness, not how much. Because if we match orders, we could trade millions of shares and the price doesn't move. But when I don't show you my size, this is one of the probably benefits of the old school standing in a trading pit and looking in a crowd. And it's like playing poker. Well, the same thing happens in level 2. And I know there's so many videos, so much I want to teach. I'm not sure how to get some of this information out, but we'll just go down this trail just a little bit more. So low volume doesn't mean it's not valid. I always joke about volume. The day they tell me it didn't trade enough, so the price is no good, then I'll pay attention to it. It doesn't matter if 2 trade or 2 million trade. If the price goes up, it goes up. And that's all that matters. But that's how the low volume rallies look like, is they just keep going. And then where you get in trouble is you question the rally because somehow, I'm air quoting, there's not enough volume on the trade. And so you're like invalidating. Well, it's a false rally, because no, if you're short that false rally, you're going to lose money. If you're long it, you're going to make money. And that's the whole scenario around this is always been very misleading from that standpoint, because what happens is that aggressiveness will drive it. And they could, if you look at the algos that are here on this chart that I'm on right now, it's still projecting like 5-6 more days up, and that could happen. There's no doubt. And especially with these low volume, we could get, it doesn't have to stop at 8. The most healthy thing would be to stop at 8, pull back into these moving averages here, where my cursor is, right? Pull back into there, and then we would get maybe a consolidation and then a rally from there. That would be better, and then you're going to new highs if that happens. The interesting thing is today we see, so I'll break this out just a little bit more here. And what you'll see is the market grid, the top end of the market grid turned down, the bottom end still coming up. So we're getting what I call a squeeze. And the squeeze play, that grid will squeeze in probably for a couple of days, especially if we manage to stay reasonably flat for a couple of days. We do have FOMC, and it's coming out. So volatility could kick back up. But right now what we're seeing is that squeeze on the market grid. And the market grid is very different than the Bollinger Bands. The market grid is actually looking at daily ranges and estimating Fibonacci relationships. So it's doing something very different than like a Bollinger Band, which is working with standard deviations. And so the point is that it's a true range kind of deal that we're looking at. And if you look at any of the charts with the market grid, if you have the indicators, you'll see that it's actually about, I've calculated this out on data, it's only about 12% of the time. So we'll call it 1 out of 10 of the bars will get some sort of exceeding or going below an STX value or an RTX value. But this, back to the question, is I think that the important thing to understand is this, that volume in itself does not drive markets. It's part of the market. You have to have it, but the bigger the volume doesn't make it better. It doesn't make it go faster. If there's sellers on the other side and they're matching up, you'll see high volume and no market goes nowhere. Okay, so volume has little relevance. So I think I sunk my putt. But just going back to the markets here, from the standpoint of this configuration, you can see this is how it's looked for the last 8 days, going back to last Thursday. I could do a replay on the algo so you could see them unfold. But this is exactly what's happened is we've just been forecasting higher and higher and higher. And that is that's very significant from the standpoint of this type of rally. Could we rally straight to new highs? Absolutely. I still think we get a minimum of 3 days sideways to down, and then as many as 5. That would carry us what? This is Wednesday. That would carry us into maybe Tuesday, Wednesday of next week. So a week from now would be where that pattern would complete. But it also has the probabilities. I'm going to bring the PPMs back up so you can see the PPMs are very, very strong. So PPM 1 right now is at a plus 0.77. PPM 2 is at right now not as strong, 0.01. It's fairly flat, actually. It's just starting to turn up. And the perfect pattern would be, I'm going to attempt to use my drawing tool. We'll see if it works. It doesn't. So bear with me because this thing is floating. I'm new to the Mac, and now I've got something really messed up here. Hang on. Oh boy. All right, so I'm going to have to go hardcore here. My transition to the Mac has been pretty brutal. These are things that would be second nature on the PC. Anyway, so we'll just go with this, but that's a pattern. Let's go on. I'm just going to run through the markets. I hope that you found that. Yeah, so somebody said about, no, fortunately, he, just about the invader last night, fortunately, he just decided to run off. She actually confronted him. She does know a fair amount of Taekwondo, and she just like, okay, what's my move? Is he coming? And so she was kind of on her own out there. So pretty impressive, especially with everything she's been going through. It's absolutely crazy impressive. Yeah, so Chu Yang 835 is a very strong possibility. One of the things, if just for on the, there's a question here. He was talking about the pattern, the 835, the 855 or 858 end up to be kind of a Fibonacci sequence. Those are a lot of the things that drove. I'm going to do a video on those patterns because they're really, really handy, especially with patterns like what we're seeing right now. And so, yeah, so hopefully you found that part interesting. Let's go ahead. Yeah, so as far as the forecasts go, you can see the PPM's about to turn down here. And that's suggesting we're going to pull back maybe into, we're looking maybe a pullback into mid the last 2 weeks of August, maybe a pullback into those numbers into September, but it starts to look a little flattish here from the standpoint of what's going on here. So yeah, always love those good lessons that we get a chance. So thanks for the question, Natalia. I appreciate it. All right, let's go to the NASDAQ. NASDAQ has an interesting pattern. It's not as bullish on the forecast here. Let me bring this up. You can see it's starting to, looks like it still wants to go higher into next week. and then it flattens out, where the S&P has a much different pattern. I believe right now we're roughly 4.3, 4.5% off the high. We're just a touch over now, I think 1.25% on the S&P. So the S&P's been basically the leader from that standpoint. So we're really really looking at the at that configuration being a bit weaker. Bear with me, I'm shutting down something here on the other page. So yeah, so this pattern you can see much different. The algos are much different. They're flattening out. We bounced perfectly off of the 200 period moving average. And I remember on our way down, I was looking for a potential of that to happen, but it actually happened. I didn't think it would, but it did. And so we went all the way down just below the 200. That was way too extreme. And oftentimes what happens in this type of configuration is what you'll see is markets get way ahead of themselves and going, in this case, I would argue that the entire carry trade was just a narrative that was put out there. And while some of it, there probably was some unwinds going on, it wasn't the end of the world that everybody was saying it was going to be. And so what happened is, if you look at the gap between the 40 period moving average, a 40-day moving average, and the 200, we went down and then we rebounded right back over the 40. When I see that type of action, to me, that's the normalization. The market's back to where it should be. And while this has been a big rally and folks want to extrapolate out that there's more to it, I think a consolidation coming back into the, I wish I could draw this in. I thought I had everything figured out on how to get to that tool. But possibly if I inverted anyway, what's happening is it looks like the moving averages, everything's going to flatten out. If I bring up you can see on the PPMs, they go flat big time on the projections. Now this is way out in the future. It's going to adjust, but it does look like we're going to challenge sometime in the next, we'll call it 5 to 8 trading days. We're going to see the market come back and probably test at least the 40-day moving average, come back into the lowest average in the pattern, which is right now the 21. That number is 19,017. And let me just look at the number here 1 second. Yeah, and the pivot number is going to be 19,617, which is the 40-day moving average, and that's just an SMA, no special weightings or anything. Yeah, so just real quick on Henry's comment, Jackson Hole won't face, I don't think it's going to have much of an effect. If anything, anytime Powell talks anymore, it tends to be perceived as dovish, because the markets themselves, that's market sentiment talking when you see that. Yeah, so Suzanne, just a quick, daily patterns, no, they all work together. Like I said, maybe one day we just need to hang out and go through all these questions. I don't know what the video would be like on a replay. Back in, I guess in pandemic days, I used to do very long 3 hours of live stream. So I wouldn't be against if I have the time to do a very long live stream and just make it all education, talk how to handle all this stuff. But it depends on what type of patterns trading, all that stuff can be set up. So I just don't have the time to go through that. We'll have to go with the use of volume, and understanding volume is a key lesson tonight. But yeah, so looking at this pattern here, everything's going flat. You can see the PPMs are being forecasted. What happens is, because we're trading above the 21-day moving average, the prices, as long as we stay above the 21, that ppm2 is going to, the value of that 21 period moving average is going to move higher, because it's going to seek that the more days you get above the 21, it's going to normalize at some stage. It's even going to come back to it, or it's going to normalize somewhere in between there. And we have that rising 10 period moving average right now, which is an absolute screamer. Right now it's whole integer 1.03, which tells you there's only a 10% probability to take out that 10 period moving average right now. That's 19,268. Let's get a rate of change on this. It's going up basically 200 points per day. So that's going to normalize. It'll be up at where the 40 period moving average is, which is going to be the key number, that 19,617. We should see it probably roll over. Maybe there's another day or two of elevated prices, we'll call it, and then a rollover, but that's what's being forecasted. The way to take these AR forecasts and machine learning and apply it to the markets is just to, like I said, is to add into, like we're talking about the 835s or 858s, those different patterns. You can see what are the expectations for that to occur. And so what's saying right now is we've had this extended rally. I would say the probabilities are, doesn't have to happen, the probabilities are leaning to coming back in somewhere in between the 40-day moving average at a value of 19,620, we'll round it off, and coming down to that 21 period moving average at 19,000. We'll just round off numbers. So we should come down into that pattern. That would be the best thing. And then from there, we'll be able to judge whether we're going to consolidate and rocket, make another ATH, all-time new high, or what's going to happen from there. Right now, to make that call, you can make it, but it's a guess. What was easy to do was actually to pick that outside reversal bar. I talked about it a little bit in Substack, but going back to Thursday, 9 days ago, going back to that Thursday, what we saw was an outside reversal, and every pattern, that 3-day trade or the 3-bar trade that I talk about all the time, that pattern unfolded perfect. And we basically even exceeded out of the pattern. You could have done something so simple with that pattern. The day after the reversal, you went long, and you could have followed it up, just putting a stop under the previous day low, and you find yourself up where we are right now. Now, we're finally at the pattern. The low, this is NASDAQ daily. The low right now, yesterday was 19,743, and we're looking at 19,785. So we take out yesterday's low, that's going to be enough to probably signal a move back to the 40, potential of coming to test the 10, and over the next several days, the momentum on the 10, that angle of attack will burn off, and then there'll be probabilities of penetrating above the 10 period, then rolling down to the 21, and that would be the most likely pattern to occur. Yeah. So Mike's got a good question here. I can probably jump into that question. He's asking about the inflation. I'm going to bring up a screen here real quick. Hang on. I'm going to have to do this the old-fashioned way. So what I'm going to show you here is this pattern right here. Wrong. This one right here. So this is the inflation forecast. And so it's interesting because my scenario, I've been talking about this echo bounce. What's being forecasted here, you can see where the highlighted area and the red dots are coming into really all the way into next year. It's being projected we're going to see a rebound in the inflation, and that's very, very likely. I'm not sure what will drive it at the moment, but this is just a forecast. But if you looked at what these red dots were doing 4 months ago, they forecasted that we would come up like we did. The same thing with this chart here that I have. This is the forecast for interest rates, and it's got it coming down in early 25. We start to see some of these forecasts come in here. I was hoping I had another chart here, and I don't have it available. But the patterns that we're seeing here on inflation do suggest that it's going to come back. And I keep arguing, listen, these are reasonably simple models, but here, what do you think the Fed's looking at? They have their own models. They can see a lot of data. They have access to all of the data. And I argue all the time that they don't wait to get the reports when we do. Powell will say, oh, we'll see how that report comes out. No, they already know. As soon as that report is calculated and is ready for release, they don't finish the calculations the day of the report. It's always looking back anyway, the monthly numbers. So not only do they see the numbers that are going to come out, they also see numbers that are being reported somewhat in a real-time basis. I have an old friend that worked at the Fed for a while, and I'm telling you, this is the reality. And Powell is going to say, well, we really don't know. Well, they do. And so their models most likely are telling them that there is a possibility, a probability for inflation to increase as we come into early next year. We're going to have a new administration of some sort, and we'll see what comes out of this. But certainly, if the things that I've seen come out of Kamala, this is not even close to being right, or maybe the beginning of the next surge as we go into free money for everybody again. And so if that happens, then that's the case. So I would argue that, I would argue that the fiat printing is the case, but it's also, government spending. And I've been talking just to kind of not get too far down the trail because I want to get through these other markets. Where we at? 47 minutes. We're going to run over tonight, folks. So I want to get through this stuff. But we've had, I think, a good conversation tonight for sure. And but the idea here is that the Fed is looking forward. They see, I think, what I'm seeing, that there is an echo bounce. That's why I keep arguing. I don't think they do anything in September and maybe November. But if I go back to this other forecast here, I pointed this out. There's a video on there. I need to crop out this one section, but I went through all these flat periods going all the way back to, I believe, 2000 on the Fed. This is the Fed funds rate. And every time they've held Fed funds flat, whether it's coming down and flat at the low or flat at the top, we've seen these big reversals. And right now you can see the forecast. I've forecasted way out in the future, but for sure we're probably going to these rising moving averages, which are going to put us, in here, at 4% on, this is the front end of the yield curve. So instead of 5.25, 5.3 on the effective Fed funds rate, you're going to see 5%. Then you'll see probably 4.8. And I've been arguing a flat yield curve. I don't have the yield curve up here, but that's what I've been arguing for a while. So, okay, folks, let's see if we can get through the balance here. And so we're at NASDAQ. I'm going to do nonstop. I'm not going to answer any more questions. Yeah, so Peter hasn't been right for what, 20, 30 years? Um, yeah, so that's a good sign that I'm right, actually. Um, but there is certainly, I would argue this is my argument. I just have to put this out here. The the reason why the reason why the yield curve looks like it is right now, and I I had some guy telling me, I think on Twitter, that they're after the version of the yield curve has been so long, there's a 75.6% probability that there'll be a recession. And I think I said, what you're saying then is that there's a 25% chance that it won't be. And I'm telling you, this is the reason that all the events that he talked about in this tweet, I've lived through and traded in markets as an institutional level trader. And all I can tell you is that there were market events that drove the inversions back in when these things happened. Right now, we're seeing a forced event. Otherwise, the Fed is forcing rates to stay at 5. I believe if they were a free market rate right now, that we'd be somewhere between 375 to 3.25 on the Fed funds, and the back end of the curve wouldn't move at all. You'd still be at 4, maybe 3.75 to 4.25, 4.5. And what you're going to get is this yield curve to steepen from where it is, but that is the natural position. My argument is that the reason why they're going to lower rates, they're just going to let them float back to normalization. And if you've been following me for the last year and a half, 2 years, this is what I've been telling you. What the Fed wants to do is normalize yields. So they kept the front end to help fight the inflation, keep things up. They let the back end float. This is supply and demand on the back end of this thing. So what you're seeing is the demand on the money is causing what you're seeing rates drop down to 375 to 4.25 is kind of a range there. And so that reflects the economic activity. The front end of the curve being held here right now is actually starting to hurt the banks a little bit. They need a little bit of an inversion and have that steepening back in. That's going to actually normalize the final part of the normalization. So the cycle goes normalize the back end, raise all the yields, let them come up. Then once the yields get to the point, start to bring them down gradually. And it'll be probably, like I said, about a half a point. It's not to stimulate anything. It will probably be interpreted as a stimulant, but it's really the final phase of normalization. And then we'll find out where the economy is and all those things. And if it goes into a recession, somebody's going to go, I told you so. The point is that there's no recession from that standpoint. So when you start to, I've been around these things a long time. And when I was a young lad, I started in the markets when I was 28. And in 1979, I had to do like a lot of you. I had to go back and look at the charts and look at what was going on prior, going back to, and I'm going to cover this in this video I'm putting together. Everything changed in 1970, but the bottom line is everything used to work prior to Arthur Burns coming into the cycle. Used to work much differently in the old days, so to speak, than what they worked from 70 to going forward. So the Fed's been very active in moving yields around. And all my argument is I think they want to go back to the longer term viewpoint and not get involved in all this stuff. So normalization of the markets is what you're seeing. And it's a long cycle, especially when you hold yields down for 4 and 5 years artificially. So they should have never been at 0. They should have been 2.5 plus during the time when they were 0. And they should never have been 5.25. They should have been 3 something. But the Fed took that tactic to fight inflation. 2 things to fight inflation: is one, the actual numbers. The other one is market sentiment or future expectations of inflation is going to cause those movements as well. So they wanted to just to let everybody know, don't get those future expectations because we're going to keep these yields up. And it psychologically, that's what causes the markets to start to normalize. And I believe once they normalize, then you're going to no longer see the tail wagging the dog. You're going to see the dog wagging the tail again. And we've been in the tail wagging the dog for decades, actually, going back to probably, we'll say Greenspan to a point, but Helicopter Ben and Yellen, I don't even know what that was. That was like a twilight zone when Yellen was running it. But the point is, this is the normalization of how things look and getting back to normalized yields and letting the markets run it versus the Fed manipulating it. And I know they could go back to that. I think if Powell gets at least another term, it's possible that if he wants to do it, he could do maybe another 8 years from here. I think he's a year or two younger than me, so that's certainly possible. I'm hoping to be around for a while. And the point is that if he gets the opportunity and that strategy that he's trying to execute actually gets done, you're going to see a much different future from there. And I won't bring in economics and growing your way out of deficits and all that stuff, because I know everybody talks about just the U.S. is over and all that. So anyway, another rant. You get two of them tonight. So I'm just going to blow through and talk about markets. I'm going to go off screen. I'm just going to go through all the charts. I'll come back up when I'm done. All right, so we just went through NASDAQ. Let's bring up the Russell just to take a quick look. Russell, you can see, is very flat in it configuration. This is daily. You look at it's really pretty much stalled already. You got this lower 21 period moving average. So if you have the indicators and stuff, just bring up the 10, 21, 40 SMAs, and then have the 200. You can see we're really just sandwiched in between the 200 and this declining 21. And there's a decent upslope, so there's support right here at the 2120 level, we'll call it. So we got an outside reversal yesterday, by the way, you can see here. And now if we close lower today, then we could get 2 or 3 days lower. And that is exactly, that's exactly what you're likely to get. That goes into the 8-5-8 pattern. So we'd have 3 to 5 days down in this next cycle. This is set up perfect to lead this or to participate in it. So sometimes we've seen some of these indexes are a little cleaner than others. Okay, so let's go ahead and just talk about the 10-year. And like I said, get the Substack, kendallreport.substack.com. Sign up for a free trial. Do the annual. You get $12 a month. Here we go with I talked about the 380 level. We're at 381. We should kind of cap out. Looks like you can see the forecast here on the red dot forecasting is actually suggesting stabilization around here. 380, 410 is the top end. So we should see this downward slope 21 is going to be the key to watch. It's at right now 3.99 and declining. So that's going to be 3.95, say 4% a cap. Maybe if we stay sideways enough, we'll be able to move above that. So let's do DXY next. So Dower's finally getting hit pretty good. Matter of fact, I'll bring up the yen too, just to kind of forecast. We can see the Dower's looking to stabilize. Look at the PPMs. This is kind of the extreme. Let me do this. Yeah, so we've got an extreme fib target down here at 100.78, and that's likely to be that could be the extreme. It also coincides with the, if you look at the market grid, it's in one of what I call these channels it's set up, and it's in a steep downward channel. So it'll probably take about 2 days from here to stabilize. That's what the algos are suggesting as well. They're suggesting some stabilization as we come into probably towards the end of next week, which should start to stabilize a bit and then probably run back up into these numbers. So let's go to dollar yen here. All right, so yen is starting to strengthen a little bit again. It's coming back. I talked about this in Substack. I think I covered it a little bit over a week ago. And we're looking at down to 141. I thought we'd retest this as kind of a potential right shoulder, and then we should see a move up. But you still have a lot of downward pressure here. PPM1 is flattened out a bit. But you look at the algos, they're suggesting a flattening pattern and then a rally, probably looking at the cap being around the 200-day moving average. And so my expectation is we should bottom out in the dollar yen, but top out in the yen, and then start to come back and maybe do some more consolidation before we go forward. All right, I haven't covered this forever. But let's do crude. And I want to zoom out just a little bit. We'll go to a weekly. Really interesting forecast here, actually. As you look at the daily, it just looks like really bad. But the forecast looks like stabilizing coming into September. It looks like we're going to see prices go on. Look at this. We're going out a little ways, but come into the election, it looks like we're going to rally, and crude oil will move on in here. But my expectation would be we stay below these averages. We get potential downside pressure here for the next 2 to 3 weeks, depending on how we trade. If we can get back above this 10-period moving average, 78.24, but that's declining. We get back above that, that will be a sign of stability. It doesn't look like we're about to go in a full-out collapse. In fact, it looks like all we're doing is retesting back over here December of last year's lows, 67.71. What's the low been so far? 61.64. So this is probably the retest, and we should start to stabilize. Overall, crude is just probably going to stay in there for a number more weeks just to consolidate, and then a possibility of moving higher. All right, let's take a look at gold. We keep getting these spikes in gold. And you can see we had this move up here originally up to 24.50, consolidated, got a really nice pattern. This rising 21 was dominant here, and so we're at an all-time new high. Let me just look at something here. This is weekly we're looking at. So let's take a look at the algos are suggesting sideways to down otherwise, and this is what you see in the red dot forecast, is that we're seeing a sideways movement here. So just continuing to go sideways. Let's go ahead and let's flip over to a daily real quick, get a short-term view. So I would say on gold, look for a high-level consolidation. We do have some upward fibs targets here. Let's take a look at this real quick. We've got 3 targets, minimum 25.74, 26.38, 26.78. And I'm just going to touch on it real quick, but I'm going to bring up silver. Silver's got a little upside, but man, this is like the Russell. It's just a laggard. So really what we're seeing here is just a pretty big consolidation. The forecast is just for more. Like I said, it's almost, it's another dog with fleas. Doesn't look like it's going to go very far. We did run up pretty good. Finally got into a $31 range and then, right back to 26. So it looks like it's stuck in this range right now. All right, on to Bitcoin. We got a daily Bitcoin up here. We rejected off some numbers here again. And if you look at the algos right now, just not anything good that looks like it's going to come into play here. The realities are that Bitcoin has been, since the halving event, has just been stuck in this range. The absolute extreme around 70,000 round numbers, and then we printed down to 50,000. We did print to 49,000. But the deal is that we're looking at the really a lot of still downward pressure, but more consolidation. Looks like it looks pretty bad from that standpoint. Let's go to a weekly chart just so we can get a little longer look here. Yeah, this is even confirmed. You can see the rising 40 period moving average currently. The PPM value is 2.04, whole integer 2.04. That's really, we'll call it bullish, but the support characteristics of an angle of attack at that level is very strong. That's 57,300 round numbers. Should be able to trade off there. We're bouncing right of there right now, 57.8. Low so far this week. Last week, 56.1, and then the previous week was that 49 print. So we rebounded, just like I was talking to you earlier about these markets that go down below these rising moving averages. They correct back, and what you know is that the market is now priced fairly from the standpoint of what's going on. There's still a slight upslope, like I said, on the 40. You're probably going to look at a range, just rough numbers, still 64, 65,000 and 57, maybe 56 on the downside. That's pretty much what it looks like from there. Okay, folks, not too bad, hour and 10 minutes. So I ran over a little bit. I try to keep these things to an hour. I really appreciate everything. I would love to go through NVIDIA, PayPal, Tesla. I'd love to do all that, but I'm gonna call it quits here. Yeah, hit the like button. That would be nice. Why not? It won't hurt. Yeah, folks, listen, I wish I could be as consistent as I was for years. I'm still I still want to do these to give you market perspective. I know a lot of folks look for that, but I do my best on the Substack, so kendallreport.substack.com. You can actually go to kendallreport.com/newsletter, get to the same place. Yeah, listen, by the way, I won't bring it up, but our system's long Tesla. It's been long Tesla for a while. So I just, I like Elon a lot. I think he's an awesome guy. I think he's really smart, but he has a lot of vaporware in his life. He's always talking about everything that doesn't exist, going to Mars, FSD, robo-taxis, all that stuff's just hype to me. Even, what is it, Waymo or something in San Francisco, they've got, they've had some success running their robo-taxis. They have pretty much a a reasonable, what best way to put it, like a map that they follow. They have a matrix that they're running in, and from what I understand, they don't go much outside that matrix. The problem with FSD, and I warn everybody, be careful, because there's 2 or 3 lawsuits right now with manslaughter cases. People are using FSD. One guy in Seattle ran a red light by using FSD and killed a guy on a motorcycle. So, if you're using this stuff, it's pretty good. I love the assisted driving on my car. I get how cool it is from that standpoint, but there's a lot of danger. I can hardly drive one of our other vehicles because I have to actually drive it, because I'm so used to just having it locked in the lane and I'm not going to run into anybody, all those kind of things on my car. So that is that it kind of makes me, when I get into I call it a real car that you have to drive, you really have to focus. I tend to, and when I first drive, to get out of lanes a little bit, drift the lines just a little bit, because I'm used to it staying where it's supposed to. But anyway, really appreciate everybody coming tonight. I know it's somewhat impromptu. I'm sure there'll be several thousand that watch this, so appreciate it. I know it's long, but I think there's some really good content in there for sure. Anyway, all right, folks, we're going to call it quits. Thanks for showing up. Hit the like button before you go. It'd be nice to have 400 or 500. I feel like anybody that watches this thing for more than 10 minutes, maybe we'll go 20 minutes. You watch 20 minutes, hit the like button before you leave. All right, folks, have a great evening. We'll see you on Substack. Yeah, the M4 competition does do a pretty good job. You guys got my number. No, I couldn't tell he was a Venezuelan, actually. It just looked different. I live in Arizona. We have lots of Hispanics here, and he just looked very different. One of my friends said he looked almost Asian in a way, so who knows? Anyway, thanks a lot, folks. See ya.